Future financial freedom seekers. Before we dive deep into the incredible world of dividend investing and how it can help you quit your 9 to 5, smash that like button and subscribe to the channel for more wealth building content. Hit that notification bell to stay updated on all our latest financial tips and strategies. Today, I'm going to share with you the exact blueprint I used to build a passive income stream through dividend investing that eventually allowed me to say goodbye to my corporate job. This isn't some get-rich-quick scheme, it's a proven, time-tested strategy that has created wealth for generations of intelligent investors. I'll show you how to start from scratch, even if you only have a few $100s to invest. But first, let me tell you a quick story. 5 years ago, I was sitting in my cramped cubicle, staring at spreadsheets for 10 hours a day, wondering if this was all life had to offer. My turning point came when I received my first dividend payment of $7.32. Yes, you heard that right, just $7.32. It wasn't much, but it was the first money I had ever made while sleeping. That small payment opened my eyes to the incredible potential of dividend investing. Fast forward to today, and I'm generating over $5,000 in monthly dividend income, enough to cover my living expenses and then some. Now, what exactly is dividend investing? In its simplest form, dividend investing means buying shares in companies that regularly pay out a portion of their profits to shareholders. Think of it like owning a small piece of a profitable business that sends you a check every quarter. Companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble have been paying and increasing their dividends for decades, even during economic downturns. The beauty of dividend investing lies in its compounding power. When you reinvest your dividends to buy more shares, you're essentially creating a snowball effect. Each new share you own generates more dividends, which buy more shares, which generate more dividends, and the cycle continues. This is how small investments can grow into significant wealth over time. Let's break down the key principles that make dividend investing so powerful. First, you want to focus on quality companies with strong fundamentals. Look for businesses with solid balance sheets, consistent earnings growth, and a history of dividend payments. The best dividend-paying companies have what we call a competitive moat, some advantage that protects their market position and ensures they can continue generating profits for years to come. Second, pay attention to the dividend yield, but don't chase the highest yields blindly. A dividend yield is simply the annual dividend payment divided by the stock price, expressed as a percentage. While a high yield might seem attractive, it could be a warning sign. Companies with unusually high yields, typically above 7 to 8%, might be in trouble, and their dividends could be at risk of being cut. Instead, look for companies with yields between 2% and 6% that have a history of increasing their dividends over time. The dividend payout ratio is another crucial metric to consider. This ratio tells you what percentage of a company's earnings are being paid out as dividends. A payout ratio between 40% and 60% is generally considered healthy, as it means the company has enough room to maintain and grow its dividend while still reinvesting in the business. Be cautious of companies with payout ratios above 80%, as they might struggle to maintain their dividend if earnings decline. Now, let's talk about how to build a dividend portfolio from scratch. The first step is to open a brokerage account if you haven't already. There are many great options available, like Fidelity, Charles Schwab, or Vanguard, that offer commission-free trading and excellent research tools. Many of these platforms also allow you to automatically reinvest your dividends, which is crucial for maximizing the power of compounding. When starting your dividend portfolio, diversification is key. Don't put all your eggs in one basket, no matter how solid the company might seem. Spread your investments across different sectors and industries. A well-diversified dividend portfolio might include consumer staples, utilities, healthcare, technology, and real estate investment trusts, REITs. This diversification helps protect your income stream if one sector experiences difficulties. Let's discuss some practical strategies for building your dividend portfolio. One popular approach is the dividend growth investing strategy, where you focus on companies that have consistently increased their dividends for many years. These companies are often called dividend aristocrats, SP 500 companies that have raised their dividends for at least 25 consecutive years. This approach emphasizes quality and reliability over high current yields. Another strategy is the dividend income strategy, which focuses on maximizing current income by investing in higher yielding stocks. This might include REITs, master limited partnerships, MLPs, and established utility companies. While this strategy can generate more immediate income, It often comes with higher risks and potentially lower total returns over the long term. A balanced approach might combine both strategies, allocating some of your portfolio to steady dividend growers for long-term wealth building while including some higher-yielding investments for current income. The key is finding the right mix that matches your financial goals and risk tolerance. Let's talk about some common mistakes to avoid in dividend investing. The biggest mistake is chasing yield without considering the underlying business fundamentals. A high yield might look attractive, but if the company can't sustain its dividend payments, you could end up losing both your income stream and your principal investment. Another mistake is failing to monitor your investments regularly. While dividend investing is generally a long-term strategy, you still need to keep an eye on your holdings. Watch for changes in company fundamentals, dividend coverage ratios, and industry conditions that might affect your investment's ability to maintain and grow their dividends. Now, let's address the question on everyone's mind: how much money do you need to generate meaningful dividend income? While the exact amount varies based on your living expenses and lifestyle goals, let's work through some numbers. Assuming you're targeting a 4% average yield across your portfolio, you would need $300,000 invested to generate $12,000 in annual dividend income, or $1,000 per month. That might seem like a lot of money, but remember, you don't need to start with that amount. The key is to begin investing consistently and let compounding work its magic over time. If you can invest $500 monthly and achieve a 7% annual return, including dividend reinvestment, you could build a $300,000 portfolio in about 20 years. The journey might seem long, but the sooner you start, the better positioned you'll be to achieve your financial independence goals. Let's talk about tax considerations, as they can significantly impact your dividend income strategy. Qualified dividends are taxed at lower capital gains rates, while non-qualified dividends are taxed as ordinary income. Generally, dividends paid by U.S. companies and held for a certain period qualify for the lower tax rate. Consider holding your dividend-paying investments in tax-advantaged accounts like IRAs when possible to minimize your tax burden. Another important aspect of dividend investing is understanding the different dividend payment schedules. Most companies pay dividends quarterly, but some pay monthly or annually. By strategically selecting companies with different payment schedules, you can create a more consistent monthly income stream. This can be particularly helpful when you're relying on dividend income to cover living expenses. Let's explore some advanced dividend investing strategies. One approach is the dividend ladder strategy, where you stagger your investments across different companies with varying dividend payment dates. This creates a more regular income stream throughout the year. Another strategy is the dividend capture strategy, which involves buying stocks just before their ex-dividend date and selling shortly after to capture the dividend payment. While this can be more complex and involves more trading, it's worth understanding as your knowledge of dividend investing grows. Real estate investment trusts, REITs, deserve special attention in any discussion of dividend investing. REITs are required by law to distribute at least 90% of their taxable income to shareholders, making them excellent income-generating investments. They provide exposure to real estate without the hassles of direct property ownership and often offer higher yields than traditional stocks. However, REIT dividends are generally taxed as ordinary income, so consider holding them in tax-advantaged accounts. International dividend investing can also add valuable diversification to your portfolio. Many foreign companies, particularly in Europe and Australia, have a stronger dividend culture than U.S. companies and often offer higher yields. However, international dividend investing comes with additional risks, including currency fluctuations and different tax treatments. Some countries withhold taxes on dividend payments to foreign investors, although you may be able to claim a credit on your U.S. tax return. The role of dividend exchange-traded funds, ETFs, and mutual funds shouldn't be overlooked. These investment vehicles offer instant diversification and professional management, making them excellent options for beginners or those who prefer a more hands-off approach. Popular dividend ETFs track indexes of dividend-paying companies, such as the dividend aristocrats or high-yield dividend stocks. While they charge management fees, the convenience and diversification benefits can make them worth considering as part of your strategy. Market cycles and economic conditions can impact dividend-paying stocks differently than growth stocks. During market downturns, dividend-paying stocks often show less volatility because their regular dividend payments provide support for the stock price. Additionally, many defensive sectors that tend to maintain their dividends during recessions, like utilities and consumer staples, are heavily represented in dividend strategies. As you build your dividend portfolio, it's important to have a reinvestment strategy. In the accumulation phase, reinvesting dividends can significantly accelerate your wealth building through compounding. However, as you approach your financial independence goals, you might choose to take some dividends as cash while reinvesting others. This flexibility is one of the great advantages of dividend investing. The psychology of dividend investing is also worth considering. Receiving regular dividend payments can help you stay invested during market volatility, as you're getting paid while waiting for stock prices to recover. This regular income stream can provide emotional comfort during market downturns, making it easier to maintain a long-term perspective. Let's talk about monitoring and maintaining your dividend portfolio. Regular review of your holdings is essential to ensure they continue meeting your investment criteria. Watch for warning signs like declining earnings, increasing payout ratios, or weakening competitive positions that might signal future dividend cuts. However, avoid overreacting to short-term market movements or news. Dividend investing is a long-term strategy. As your portfolio grows, rebalancing becomes important. This means periodically adjusting your holdings to maintain your desired asset allocation and sector diversification. While dividend investing tends to be a low-turnover strategy, some trading is necessary to keep your portfolio aligned with your goals and risk tolerance. Now, let's address some common questions about dividend investing. One frequent concern is whether companies will maintain their dividends during economic downturns. While some companies may cut dividends during severe recessions, many well-established dividend payers have maintained and even increased their dividends through multiple economic cycles. This is why focusing on quality companies with strong balance sheets and sustainable payout ratios is so important. Another common question is whether to prioritize current yield or dividend growth. The answer depends on your personal goals and time horizon. If you're young and have many years to invest, focusing on dividend growth companies might be more appropriate, as they often offer better total returns over time. If you're near retirement or seeking immediate income, a higher current yield might be more important. Looking ahead, dividend investing faces both challenges and opportunities. Low interest rates have pushed many investors toward dividend-paying stocks for income, potentially making some dividend stocks more expensive. However, demographic trends, with aging populations seeking income investments, could provide ongoing support for dividend-paying companies. As we wrap up this comprehensive guide to dividend investing, let's summarize the key points. Successful dividend investing requires focusing on quality companies, maintaining diversification, reinvesting dividends for compounding growth, and staying committed to your long-term strategy. While it's not a get-rich-quick approach, dividend investing can provide a reliable path to financial independence through growing passive income. Remember, the journey to financial freedom through dividend investing is a marathon, not a sprint. Start where you are, invest consistently, and let the power of compounding work for you over time. With patience, discipline, and the right strategy, you too can build a dividend portfolio that generates enough passive income to quit your day job. If you found this information valuable, don't forget to like this video and subscribe to the channel. Hit that notification bell to stay updated on our latest content about dividend investing, passive income strategies, and financial independence. Drop a comment below with your thoughts or questions about dividend investing. I read and respond to all comments. Thanks for watching, and I'll see you in the next video. Want to take your dividend investing journey to the next level? Check out my comprehensive dividend investing course, where I share my complete system for building a profitable dividend portfolio. Click the link in the description below to learn more and get started today. Use code DIVIDEND10 for 10% off your enrollment. Don't wait, take control of your financial future now.